Good day everyone. In this lecture video, we are going to talk about the income tax on international carriers as explained by the National Internal Revenue Code and updated by the Republic Act 10378. I'm Eileen Fayem Africa and welcome. So first off, let us talk about the international common carrier, its definition. First, common carrier, this is an entity that transport goods or people from one place to another for a fee. International common carrier refers to entities that transport passengers, mail and excess cargoes or baggage from the Philippines to any destination abroad and vice versa. So, in the NIRC, international carrier is treated as resident foreign corporations. So, we have a special rate for this. This is a special corporation. And those that fall into this are some examples would be the Singapore Airlines, the Emirates, the Qatar Airways, and the shipping company of Nippon. So, those are foreign corporations. So there we have international air carrier and international sea or shipping carrier. These two are our international common carriers. Now, what is the tax rate for this special corporation? As a general rule, international common carriers are taxed at 2.5% of the gross Philippine billings. On the other hand, we have an exception rule, preferential rate or exemption on the basis of reciprocity applicable tax treaty or reciprocity. What does this mean? As you may recall, in the general principles of taxation, we have the International Committee. So, if there is a tax treaty between the Philippines and another country, what will you use? What rate will you use? The tax code that is the rate that is specified in the tax code or in the tax treaty? Well, it is always the tax treaty that will prevail because of reciprocity. For example, the Netherlands offers the Philippines a rate for international carriers for only 1.5%. So, as a good behavior for the international relations, the Philippines will also use the 1.5% rate to tax the international carriers from the Netherlands. So that is called the reciprocity. So what is the gross Philippine billings? How can we compute this? What are the line items? For international air carriers, gross Philippine billings includes the amount of gross revenue derived from the carriage of persons, excess baggage, cargo, and mail originating from the Philippines in a continuous and uninterrupted flight, irrespective of the place of sale or issue and the place of payment of the ticket or passage document. So, regardless on the place that you bought the ticket, whether it is in a foreign country or in the Philippines, if you are going to take a ride, if you're going to travel from the Philippines to any other country, that is called an outbound flight, okay? Continuous and uninterrupted flight. So, you have no stopovers. Then, from the Philippines to that point to the other country, you may compute the gross Philippine billing. So, it is included in the gross Philippine billings. The fare, the ticket fee. So again, originating from the Philippines. The flight will be from the Philippines up to the point where you are going to the other country. Next, we have the international shipping carriers. So the gross Philippine billings include the amount of gross revenue, whether for passenger, cargo, or mail originating from the Philippines up to the final destination, regardless of the place of sale or payments of the passage or freight documents. So, both the international air carrier and international shipping carriers, the computation of their gross Philippine billings are just the same. So, your originating country must be the Philippines. Okay? No other country. So, again, regardless where you bought the ticket, as long as your flight or your voyage will be originated from the Philippines. Exclusion in gross Philippine billings. So, what items should be excluded in the computation? So, first, we have the non-revenue passengers. So, this includes the passengers that won in a raffle. For example, that particular airline conduct a contest or a raffle, and then one or more passengers won. Then they will have a free travel ticket. So, from the Philippines to any other destination. So, they are non-revenue passengers. Of course, they won't buy any tickets, so that airline will just have to hand the tickets to them. Will just give the tickets to the passenger, so they are non-revenue. Okay. The supposedly fees are excluded, of course. And then the refunded tickets. So, the refunded tickets, here, the tickets are already paid by the passengers. However, they chose to refund the ticket. Or maybe something happened, so they won't be able to fly or ship, anymore to continue the voyage or the flight. So, like that. So, these are the things that should be excluded in the gross Philippine billings. Revalidated exchange or endorsed tickets. So, what are this? Tickets that are revalidated, exchanged, and or endorsed to another international airline from part of the gross Philippine billings of the carrying airline if the passenger boards a plane or a port or point in the Philippines. So, for example, my airline, Africa Airlines, for example, exchange or endorse to another international airline. So, for example, Asia Airlines, 100 or 200 passengers. Then, the fees that the passengers paid to the Africa Airlines, that paid to me, won't be part of my gross Philippine billings anymore. Since I will endorse them to another airline, then they will form part of the gross Philippine billings of the carrying airline. So, just like that. So, this is an illustration, our first illustration. Montego Air, a resident foreign carrier, summarized the following results of its Philippine operations during the second quarter. Okay, so we have here inbound flights given, outbound flights given, then the total, we have the gross receipts here, less the direct expenses. Okay, so then the other common expenses, net income 5.4 million. How do we compute the income tax due of this? So, Montego Air shall pay the following income tax. How can we get the gross Philippine billings? Again, the flights that only originate from the Philippines. So, we will just get the total of the outbound flights. So there, we have 9.2 million. Then our tax rate, we shall multiply it to 2.5%. Then our income tax due would be 230,000. So just like that. For our second illustration, we have here a shipping company. So Oceans 8, a resident foreign shipping company, shows the following data of its gross receipts from passengers and cargoes during a month. Okay, during a month. So we have here the fares billed in the Philippines, fares billed abroad, incoming shipment, outgoing shipment, the total for each. The total billing, 16 million. Okay. Another information would be fares from non-revenue passengers and fares canceled and refunded. Alright. So how can we compute the first, of course, first step would be to determine our gross Philippine billings. So, from the given, we have incoming shipment and outgoing shipment. And the fares billed in the Philippines and also abroad is reflected here. Again, regardless of where you bought your ticket, whether it is bought from the Philippines or other country, it is not an issue in the computation of the gross Philippine billings as long as the fare would originate from the Philippines. So we shall focus on the outgoing shipment. Okay? So the total billings for the outgoing shipment would be 9 million. So fares from non-revenue passengers, focus on outgoing shipment, 490,000, and then fares canceled and refunded, 560,000. What shall we do? So, the outgoing shipment total billings 9 million, and the fares canceled and refunded shall be deducted from the total billings. So, why? I thought we're just gonna ignore this. No? Well, the fares from non-revenue passengers, you really did not have any income on that because you just gave it away for free. So, no amount of money has been, you did not have any inflow from that. However, in the fares canceled and refunded, the passenger already bought the ticket, so you already have the cash inflow because of the fare. So, we shall deduct from the total billings the fares canceled and refunded. So, 9 million, you deduct the 560,000. So, to continue, Oceans 8 shall pay the following income tax. Total billings for outgoing shipment, 9 million, less the tickets refunded, 560,000. We have here a total gross Philippine billings of 8,440,000. Now, let's multiply it to the 2.5% rate. We're going to have 211,000 as our income tax due. Next, we have rules on transshipments or interrupted flights or voyages. What does it mean when we say transshipment? So, if a cargo is in a ship and then you're going to transfer it to another and different ship, different line of ship, and then it will be transshipped. That is called transshipment. Interrupted flights, those airlines that stop over here in the Philippines and then continued to flight from the Philippines to another country, to the destination or its final destination country. So the flight is interrupted. How do we deal with that? Okay. So we have an illustration. Manifest Airways, an international carrier, had the following gross receipts on outbound flights for the first quarter. So, in the given, it is already said that these are just outbound flights. So, we're not going to get confused to not include the inbound flights anymore because it is not included in this table. Okay, so we have destination Taiwan, Cambodia, India, China. The ticket fare, we have the column here. The number of passengers for each destination country, the total amount, and the total gross receipts. Okay, so there, I already showed the complete solution, but before any of that, let's focus first on the given. Okay? So, and these are the following additional information. Okay. So, the flight to Cambodia was transshipped in Vietnam to another plane of Manifest Airways. So, wait, in a moment. Okay. So, again to continue. We just have our given here. Okay. Let us not dwell uh too much on the solution that were shown earlier. So first we have additional information. The flight to Cambodia was transshipped in Vietnam to another plane of Manifest Airways. So the flight to Cambodia was just transshipped in Vietnam to another plane of the same airline. Next, the flight to India is endorsed to another air carrier that airlifted them from the Philippines. Then the flight to China was transshipped to another carrier which airlifted them from Taiwan. So first, the flight to Cambodia. Is it included in our gross Philippine billings? So let's see. First, we have the Taiwan. These are the items included in our gross Philippine billings, okay? The Taiwan doesn't have any interrupted flights, so it is just on an uninterrupted flight from the Philippines up to the final destination of Taiwan. So, all of the total amount is included in the gross Philippine billings. Next, the flight to Cambodia was transshipped in Vietnam to another plane of Manifest Airways. So, it was transshipped in the same airline. So, we do not have any conflicts in there. Okay? So, for example, flight 111, the passengers of that flight was transshipped to flight 112 in the same airline. So, the fares in that two planes were just included in the same company. So, Cambodia, total amount 2 million pesos. Now, the problem that we're going to analyze here is the additional information number 3. The flight to China was transshipped to another carrier, which airlifted them from Taiwan. So now, the total ticket fare, are we going to use this, the total amount? No. Why? Because from the Philippines, the outbound flight just went to Taiwan. From here, up to the final destination of China, other airline carried the passengers. So, technically, our destination is just from the Philippines to Taiwan. So, let's see, the ticket fare from up to Taiwan is given 2,000 pesos, and then the number of total passengers that supposedly be heading to China is 300 passengers. So, the ticket fare of Philippines to Taiwan, 2,000, multiply it to the number of passengers originally heading to China. So 2,000 times 300 is 600,000 pesos. And for that, we have a total gross Philippine billings of 12,600,000 multiplied by our income tax rate of 2.5%. Then we're going to have the income tax due of 315,000 pesos. So the 48 rule on transient passengers. So now we're talking about a time limit, okay, a range. So flights or voyages of passengers, mails, or excess baggage commencing from foreign countries to which will be interconnected in the Philippines for a continuance of the flight or voyage to a foreign destination by the same international carrier shall not be considered originating from the Philippines if the actual departure is made within 48 hours from embarkation in the country, except only when delayed by force majeure. As such, the portion of the ticket pertaining to the outgoing flight or voyage shall be excluded from the gross Philippine billings. However, if the continuation of the flight or voyage to a foreign destination is made by another airline, company, or international sea carrier, the cost of the outgoing flight or voyage shall be included in the gross Philippine billings of that airline or carrier, regardless of the intervening period of time between the arrival and departure from the Philippines. So this is too lengthy, no? So let's explain this through an illustration. Ayan. So we have two situations here. Let's see. This is the Philippines. So we have a stopover in the Philippines. So I put the Philippine Islands in the middle of the line. For example, in this first scenario, an international air carrier or an international ship carrier has been departed to another country and then going to the Philippines for just a stopover or some delays. So let's see. If the same, okay, if the same international air carrier and international ship carrier would just leave the Philippines within 48 hours. So, same air carrier, same ship carrier, up to the final destination. We have no problem in that. Are we going to compute gross Philippine billings in here? So, this is our these are the facts that should be kept in mind. Okay. If the stopover or the delay is less than 48 hours, the flight cannot be technically computed or determined to be originating from the Philippines. However, if it is within greater than 48 hours, so 49 hours, 50 hours, it can be considered to be originating from the Philippines, except of some major delays or minor delays due to typhoon, storm, hurricane, something like that. But if the flight is within 48 hours, so until 48 hours, so this should be less than or equal to 48 hours, then we're not going to compute any gross Philippine billings in there. And the airlines and the shipping carrier are the same, okay? So, just deadma. On the other situation here, we have an international air carrier and an international shipping carrier leaving For example, they are leaving India, and then they are going to the Philippines for a stopover or due to some delays again. So that same air carrier and shipping carrier went to the Philippines now. But if another air carrier or shipping carrier is going to leave the Philippines, so the passengers here and the passengers and or shipments here will be transferred to another shipping carrier or airline company, then they are the ones that are going to the final destination, right? So for example, from India to Australia here. Are we going to compute any gross Philippine billings from the original airline or shipping carrier? No, because the flight and the shipment that originated from the Philippines is another airline or shipping company. So the gross Philippine billings there would be included in this other airline or shipping company. Okay? So we have no issue here. The flight or shipment will be endorsed or transshipped to another shipping company or airline, then we have no problem. The computation for our original airline and shipping company, okay, disregard that flight or voyage. However, here, again, if the airline company and the shipment company is just the same from the very beginning up to the point of the final destination, then we're just going to stick here. Less than or equal 48 hours, not originating from the Philippines. If the delay is greater than 48 hours, except those of because of the force majeure, then it can be included in our gross Philippine billings because it will originate from the Philippines. Okay. So, for our illustration number 4, Lionheart Airlines, an international carrier, had the following summary of flights during the fourth quarter. So we have already the direct outgoing flights, the fare and the number of passengers given, the total amount. And then another information would be the details. So we have flight number 1, Sri Lanka to Japan, number of passengers 900, status continued after 80 hours as scheduled. Next, Zimbabwe to Japan, 500 passengers, delayed 50 hours due to storm. Next, Australia to Canada, number of passengers 400, continued after 46 hours as scheduled. Korea to Canada, 450 passengers, delayed 52 hours. New Zealand to Canada, 300 passengers, continued after 24 hours. We have asterisk here in these two flights. And the information, this is endorsed to Eagle Airways, another international carrier, which airlifted the passengers to their final destination. So first that we're going to determine is the total amount of our gross Philippine billings in the interconnected flights. So let's see which of these flights is going to be included in our gross Philippine billings. First, continued after 80 hours as scheduled. This is already higher than the range of 48 hours, right? So, let's see. Okay. Yes, included in our interconnected flights gross Philippine billings. Delayed 50 hours due to storm, force majeure, so excluded. Continued after 46 hours as scheduled. So this is not included because even though it is well scheduled and below 48 hours, so not included. And then next, delayed 52 hours, however, endorsed to another airline. So not included in our uh computation of the gross Philippine billings of Lionheart Airlines, right? Also this one because this is endorsed. Okay, so only the flight of Sri Lanka to Japan. Okay. All right. So the fare that we're going to use is this one. Is from Sri Lanka, they stop over to the Philippines. We have a given fare of Philippines to Japan, direct outgoing flights of 3,500. So the number of passengers is 900. Now let's see. So Lionheart Airlines, we have a total of 3,150,000 pesos. Let's also take a look at the interconnecting flights gross receipts or gross Philippine billings from the Eagle Airways. Going back to our given. So these two, right? They are both endorsed to Eagle Airways. So the total gross Philippine billings would be from the Korea to Canada, 4,500,000, and New Zealand to Canada, 3 million pesos. So since our main problem is Lionheart Airlines Company, so let's compute the gross Philippine billings and the income tax due of the Lionheart. First, we have the direct flight to Japan, a total of 7 million. This is from the given earlier. And the direct flight to Canada of 30 million. Then what we have analyzed and computed from the previous slide is the interconnected flights. So, 3,150,000. Our total gross Philippine billings is 40,150,000 pesos multiplied by our income tax rate of 2.5%. So we have 1,003,750 pesos income tax due. So for our international data or information, foreign currency translation, whichever is higher of the following conversion rates. So this is computed when the fares from the international carrier is not translated in Philippine peso. So how can we translate that? So the rate of the Philippine peso would be whichever is higher of the following. First, the monthly average airline rate in the bank settlement plan monthly sales report. So determine that one. And the Bankers Association of the Philippines rate. So either of the two, whichever is higher. So treaty or reciprocity consideration, this was already discussed in our earlier slides. So international carriers may avail of a preferential rate or exemption from income tax on the basis of an applicable tax treaty or international agreement to which the Philippines is a signatory, or on the basis of reciprocity such that an international carrier whose home country exempts Philippine carriers shall likewise be exempt from income tax in the Philippines. So again, this is all about our international relationship to other countries. So if they are giving us exemptions, or either exemption or lower rates, then we're also going to use that rate. We're going to apply that in determining the tax due of that resident foreign corporation. Treatment of other income. So this is subject to the appropriate type of income tax. So such income as demurrage fees and detention fees. These are the charges. For example, the cargoes in a shipment. Okay. So another airline or another person is using your ship to to stock the cargoes. So we have charges for that. Or if an international carrier airline company is leasing or renting in such a short period of time the spot of an aircraft in a particular airport, that particular spot is owned by another airline, then the charges that you're going to collect from that would be your other income, right? So it's just like leasing or renting out another property for the usage or benefit of another company or airline or shipping company. So you're going to have an income. So that treatment yan, is subject to the appropriate type of income tax. Also, the other charges relating to outbound and inbound cargo such as charges for the use of property or rendition of services. It's something like that. So, the appropriate type of income tax is the regular corporate income tax. Offline international carriers, what does this mean? So, those without flights or voyages starting from or passing through any point in the Philippines. So, it's more like idle aircraft or idle ship, right? The branch or sales agent in the Philippines of offline international carriers which sells passage documents for compensation or commission to cover offline flights or voyages of its head office or other airline, or sea carriers covering flight or voyages originating from the Philippine ports or offline flights or voyages is subject to the regular corporate income tax. Of course, it's just like common thinking. Um, Earlier we computed the gross Philippine billings. But what if that particular airline or ship uh doesn't do any flights or voyage along the month or quarter? So of course it is it is offline. So that airline company or shipping company won't have any gross Philippine billings. Okay? So, the other income that it will be receiving to the branch or sales agent in the Philippines, it will be subject to the regular corporate income tax, which is, right now, it is 25%. So, there, depending if it is the regular corporate income tax. Okay, so there, uh, the income tax on international carriers. I hope you enjoyed our video lecture and I hope to see you soon in the next ones.